Hello ladies and gentlemen, welcome to today's webinar. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's session we will talk a little bit about the interest rate decision of the Federal Reserve next week. But before we proceed to the actual session, I see that there are like 5, if I'm counting correctly, individuals like attendees at this stage that are raising hands. I would like to see if there is a question actually, or you're going to ask about the session itself. So if there is a specific question that you need to ask, just put it into the chat so I can see exactly what you want to talk about, and I will hand you over the microphone. Otherwise, I would like to proceed with this session itself because there is a lot to talk about. There is also the reason why we will see the chart and mostly the majors as of the currency pairs and commodities with the pricing of the market until that point and what we can expect until next week and the meeting itself. Furthermore to that, if the time is advancing and we have little time until the end of the session itself, the charts we'll take a look at next week after this Friday's session, when we will talk about the investor sentiment for 2016. We will have a look at a few strategies that you could well implement into your trading plans due to the fact that we're heading into a new year and the fundamentals are shifting. So we have to see exactly what we will work with in order to keep expanding our profits. Today's session is extremely important, ladies and gentlemen, because next week's meeting will actually tell us whether first the Federal Reserve is let's say lying or misleading the markets by expecting rates every month by giving potential hawkish statements about the economy and its outlook, their own expectations so far, so on and so forth. The first thing that I would like to start today is to take a look at the definition of interest rate. But as I can see that some of you guys have a persistent hand that you have risen, so let me give the microphone to Mr. Ali. So, Mr. Ali, you can freely speak right now. Everybody can hear you. Go ahead. Mr. Ali, we can hear you.
I'm sorry. I just had the hand up before it was long. I didn't have any questions at the moment. Thank you very much.
All right, thank you, Mr. Ali. There is also another person that stays here with his hand up for about 4 minutes. Let me give the microphone to Mr. Tan. We can hear you well, Mr. Tan. Go ahead.
Sorry, I just broke the...
Mr. Tan, we can hear you. Please proceed with your question. Okay, I can see that Mr. Tan is either not hearing us well or the noise around him is causing him trouble to give forward his question or his statement at this stage. So I will kindly advise you, if there is something that you urgently want to say, just drop me a message. I will give you the microphone straight away. Also, you can also raise a hand. I will also give you the microphone if necessary. The mouse and my keyboards, you can also use them to make any projections on the charts that you see in front of you, or anything else that states for that matter on today's session. So, in definition, what is interest rate? The amount changed expressed as a percentage of principal by, of course, lender to borrowed for the use of assets. Now, interest rates are typically noted on an annual basis, ladies and gentlemen, known as the annual percentage rate or the APR. Okay. Now, the asset that has been borrowed could include, of course, cash, customer goods, large assets such as vehicles or buildings. Now, interest rate is essentially a rental or leasing charge to the borrower. For the asset's use, however, in the case of a larger asset like a vehicle or building, the asset rate is sometimes known as lease rate. This is also another thing. When the borrower is a low-risk party, they will, of course, usually be charged a low interest rate. If the borrower is considered high risk, the interest rate they are charged will, of course, be higher. Now, let's also have a look at a little bit more details on what the interest rate is actually implemented as, and a simple calculation of how it's actually considered. Simply because this is for those that are interested in hedging opportunities or carry trades, so on and so forth, triple profit systems from an investor's point of view, or you probably have a large amount of balance into your accounts that you're actually more of it interested into longer term trading with diversifying of your profits and so on and so forth. Interest rates, ladies and gentlemen, is charged by lenders as compensation for the loss of the asset's use. Now, in the case of lending money, the lender could have invested the funds instead of lending them out. With the lending a large asset, the lender may have been able to generate income from the asset that they should have decided to use by themselves. All right. Now, let's have a look at a very, very easy formula here. I'm just going to put it down here so you can absolutely see what we're actually talking about. Now, simple interest, we're going to state it as SI, equals to the principal, as we spoke earlier, the percentage expressed by the annual interest rate, which states for capital I, and of course multiplied by n, the number of years. A borrowing of let's say $1,000 US at a annual rate of about 6% for about 8 months means that you owe about $40 in interest. Now that would be calculated as 1,000 multiplied by 6% multiplied by 8 divided on 12, which are 8 months out of the annual rate. And using the compound interest formula, which is the so-called compound interest, would equal the principal one more time multiplied by the 1 plus the interest rate by the number of months one more time, minus 1, obviously, to give us the compound interest. So a borrowing of $1,000 at an annual interest rate of 6% for a rate of 8 months means that you owe about $40.70. Now, the interest owed when compounding is taken into consideration, which is also higher, because interest rates has been changed monthly on the principal plus the acquired interest from the previous months. As of course, the lending time increases as well, though the disparity between the two types of interest calculations also is growing. So, higher interest rates means that you owe more. That means the acquired interest rate plus previous months is rising. For shorter time frames, the calculation of interest rates will of course be similar to both methods, as, one more time, the lending time increases with the disparity of the two types of interest calculations that grows as well, which is the simple interest rate and the compound interest rate combining to acquire the interest annual rate, which is growing exponentially. Every time you owe money, you owe more every time. Now, this is somehow, let's say, probably seen by some people that have, for example, credits by any instance, let's say mortgages for some of the attendees. Will be probably interesting because the actual interest on the bank's loans that you get over the mortgage, because it's one and the same, it's actually working pretty much the same way. Now, as your maturity date comes near, the more you pay every time, because excluding the first 2 or 3 or 5 years, depending if the interest of the bank is actually stable and unchanged, which is verified as well as into your mortgage contracts. But afterwards, it grows exponentially until you actually your actual maturity date comes, so you can pay everything in full, and your last installment is actually fat, and then you owe nothing more. The property or whatever that you have leased is actually yours again, which drive us to the actual purpose of why we have to define what interest rate is pretty much because everybody knows, and have some kind of idea by using the services of financial institution that is actually charging them some kind of fee or an interest over time over a mortgage or any kind of other type of loan or lease, which particularly works the same way, but we actually don't know that the actual interest rate on a governmental type of state works the same way. It's why the government is actually using it as its most powerful tool to subdue or grow inflation. So that drives us to the next particular interesting topic today. It is what exactly happens when an interest rate rises. One of the last hurdles to the December rate of the US rate we're talking about, let me remind you one more time, we're not talking about the interest rate in UK or any other country or the Eurozone or anything in specific. Of course, the connection to everything else is more or less evident to why the Federal Reserve is keeping interest rates low at for the past almost 10 years. The first official US interest rate rise since 2006 is now very likely to happen at the next Federal Reserve meeting on December 16. The US economy evidently added more jobs than expected in November, according to governmental data released last Friday. This further backs up Janet Yellen, the Federal Reserve Chair, who gave a speech on Wednesday, clearly laying out the case for why now is the time for higher rates. So we know that the meeting is next week, but when actually the rates will rise? That gives us an opportunity to go a little bit more deeper into that particular question, and there are different ways to actually find that out. One of these is by looking at the Fed fund future markets, now where investors essentially bet on what level the interest rate will be in the upcoming months. Now, this particular event is why the Fed is considering raising interest rates now. America has seen its longest private sector hiring on record, and of course, unemployment has halved since its peak. The Federal Reserve thinks the hot jobs market could spur a pickup in inflation and wages automatically. Given it is, of course, tasked with keeping inflation low, it is considering raising the cost of borrowing to keep the economy on an even keel. And one more reminder, the unemployment has halved since the peak in 2009. So there is also a question that I've noticed among the traders that I'm working with on a daily basis. Of course, some of the traders that are working with other colleagues of mine have similar questions, which can actually, they take the answers from our explanation right now of why the rates in the US have been held so low for so long. The answer to this question is very obvious, by the way. It's what we see on a daily basis. Not only, we also see and hear this in the attitude in the statements from federal government officials, is that the US was hit by the crash in its housing market and the banking sector. That was between 2007 and 2009. The Fed, of course, felt it needed to pull out all of the stops to prevent the economy from collapsing. And this is to prevent it to go into a new Great Depression, or the so-called deflation. One way, of course, of keeping things afloat was by cutting the cost of borrowings to rock bottom levels. The current state is at 25 basis points on an annual rate. Is the economy, however, ready to cope with interest rates that are higher from today's levels? Remains to be seen. That is, of course, the trillion-dollar question that everyone is asking themselves every day. The explanations further, ladies and gentlemen, that we will give today will give you a bit more clarity on why the timing is now. An opinion, however, widely varies to optimists that the Fed has managed to engineer somehow a respectable recovery, that it's outshining many other economies. However, the quarter point increase would have a negligible impact, but is a sensible first step to ensure the Fed stays ahead of inflation. As everyone knows, or for those that have no idea, let's say that federal funds rate is an extremely important tool to manage inflation. everyone knows that overinflation means that it's much worse than deflation. Hyperinflation, much more bad than deflation. Obviously, they have to have the equilibrium of sustained 2% inflation on an annual base. And to subdue this particular inflation, they can grow and hike interest rates on quarter basis or every month, depending on the pace of the development of the economy. How fast, however, are people asking themselves, is the Federal Reserve likely to raise interest rates? Well, it's obvious that it's not going to be fast at all. If the Fed is to be believed, let's say, or trusted, one of the adopted sayings by Chair Janet Yellen this year has been that rate rises will be gradual. The pace of increase when they begin is expected to be less than half the tempo of the Fed and its last round of rate increase when it started in 2004. And the ultimate rate they will stop when is likely to be very low at any point, and not much more than, let's say, they are saying 3%. The reaction, however, from the investor side to higher interest rates is also something that traders are extremely interested in. Now, in more details, we will talk about it next time because the investor sentiment is an extremely important, let's say, indicator to the pace of the economy, its growth, and the likelihood of the investment in domestic product, so on and so forth, in order to keep the pace with interest rates. So this is the hottest and most disputed question in markets today. Some say that Fed has had made some moves to clarify the market, that they will take any interest rate increase in their stride. However, others thrive that some turbulence is inevitable when 7 years of zero interest rate policy and trillions of dollars worth of bond buying by the US Central Bank might somehow cause turmoils on the market. However, a currency trader, however, positioning themselves in the anticipation of this rate rise is why we're all here for. Not only currency traders, but when I'm saying currency traders, we all know that when we're trading commodities that are denominated in the US dollar, such as the gold, the silver, natural gas, crude oil, Brent oil, so on and so forth, all of this denominated in US dollars, and will of course have a large impact from the result, from the outcoming result next week. Currency markets are sensitive, but of course differences in interest rates tend to drive movements in the longer run rather than the shorter term. For example, if a European investor, for example, can borrow cheaply in somewhere in Germany and buy a higher yielding US bond, then all else being equal to the dollar will rise versus the euro. Now, this particular person will be very much interested in hedging himself with the dollar, with the euro-dollar currency pair for the longer run, especially if you are buying a high-yielding US bond, which the maturity date is in about 10 years from now, which is the most important one, and what we're seeing at the moment, because investors and bond investors, much more to the question, are closing their short-term exposure to the government debt funds and moving their funds to a more appropriate environment with higher interest rates, which will give them higher return. And then they will be able to trade their local currency versus the currency of the higher yielding country with higher interest rates, and diversify by expanding his profits with investing elsewhere, like into the euro-yen currency pair if you're interested in, or the dollar-yen currency pair if you're interested in. But the most stable currency pair at the moment is the cable. Anyways, there are some various questions. We've got plenty of attendees that are here for the first time, and they're not aware of the webinars themselves. So before I proceed further with some more interesting hints about the interest rate hike, I will answer a few questions here, extremely important. What we have here is one of the first questions. Let's have a look. Now, there is a person asking about the beginning of the session, because obviously he's coming here later than he anticipated. I can tell you that all of the sessions are recorded, as well as this one at this stage. So all that we do today, you can review hopefully next week when we upload all of these webinars into our YouTube channel. If, of course, you find yourself with any kind of difficulty to find the link to watch the recorded webinar, we will always be able to help you, as well as give you an answer to all questions that you might have at this stage by just going to our support department on the www.gdmfx.com, or directly drop us an email at webinar@gdmfx.com, or on another hand, call us directly on the hotline, where we will always be able to answer your questions straight away, or connect yourself directly to me or any of my colleagues by request. Also, there is another question about the situation that you find yourself in when you're muted by the organizer or the presenter. I have to tell you that I have muted all microphones at this stage, because if I leave them all unmuted, that would definitely mean that it is going to be a jungle here. I will hear everybody that's talking at his laptop or stationary computer, because your microphones are probably not muted, which means to make the session as pleasant as possible for everyone, I have muted you here. If you have something to say or you have a statement to make, don't hesitate to raise your hand or drop your question directly into the chat, and I will attend it as soon as possible. And one more time, if you need to say something, just send me a message and I will unmute you and give you the possibility to express whatever is on your mind. Thank you very much for this attention. Now let's head back to our main topic today, because we're very, very fast advancing in time, and the topic is extremely huge. And as I can see, a lot of things might be left for the two last sessions, which are next week. Now, we're talking about the currency traders, or the traders in general. Their anticipation, how they're positioning themselves ahead of this rate hike possibility. Since, of course, everyone is continuing to beat up market currencies, but the broad rally has somehow, out of this scenario that it has trying to get into. As an example, the euro and the Japanese yen have regained their strength versus the dollar. However, many colleagues of mine, analysts, traders, and of course fund managers, expect the greenback to continue to climb higher in the upcoming years, as the Federal Reserve rises interest rates further. However, does the recent China turmoil affect the Fed's decision is also a question to many investors' minds. The theory, however, is that the Federal Reserve makes its own decisions on raising rates based on its appraisal of domestic economic issue. However, with emerging markets continuing for about 39% of global GDP in nominal term and 52% in purchasing power parity terms, a U.S. monetary policy that enfeebles emerging markets risks depressing global demand and therefore impacting U.S. growth further down the line. This is particularly the case with China. In a specific sense, however, a Fed rate hike runs the risk of increasing the attractiveness of U.S. dollar assets relative to those denominated in other currencies, accelerating capital outflows from China and leaving Beijing with fewer resources to invest in U.S. Treasury debt. And we all know that the Chinese own the largest U.S. debt at this stage. So they cannot really afford to lose them as, let's say, as purchasers, as customers to a grocery store, because they have a lot of money that they can invest into U.S. Treasury debt. However, what a U.S. interest rate rise really means for the U.S. dollar itself. The U.S. Federal Reserve is almost certain to start raising interest rates when the policy meeting set on December 16 by the Federal Open Market Committee. How worried, however, should businesses, investors, and policymakers around the world should be about the end of near-zero rates and the start of the first monetary tightening cycle since 2004-2008. Janet Yellen, the Fed chair, has repeatedly said that the impending sequence of rate hike will be much slower than previous monetary cycles, and of course predicts that it will end at a lower peak level. While of course central bankers cannot always be trusted when they make such promises, since their jobs often require them deliberately to mislead investors. There are good reasons to believe that the Fed's commitment to lower for longer, I quote, interest rates is sincere. So that means that the Fed's overriding objective is to lift inflation and ensure that it remains above 2%. To do this, Yellen will have to keep interest rates very low even after inflation starts rising, just as her predecessor, Paul Volcker, and to keep interest rates in the, let's say, about the 1980s very high, even after inflation started falling. This policy is type of a reversal that follows logically from the inversion of central banks' objectives, both in the America and around the world, since 2008's crisis. In the 1990s, let me give you the example because Paul Volcker is a person that many young investors and traders are probably not familiar with. That's like 20 years ago, more than 20 years ago. Volcker's historic responsibility was to reduce inflation and prevent it from ever rising again to dangerously high levels. Today, Yellen's historic responsibility is to, of course, increase inflation and prevent it from even falling again to dangerously low levels. So you see, it's a bit vice versa, however. Under these conditions, the direct economic effect of the Fed's move should be minimal. It is hard to imagine, however, many consumers or homeowners changing their behavior because of the quarter-point change in the short-term interest rates, especially in the longer-term rates, hardly move their sentiment. And even assuming that the interest rates reach about 1 to 1.5% by the end of 2016, they will still be very low by historical standards, both in absolute terms and relative to inflation itself. Now, in this case, there has been many speculations from various medias and official publications, forums in the International Monetary Fund and other institutions that have raised their worries about the impact of the Fed's first move on financial markets in other economies. Many Asian and Latin American countries in particular are considered in this stage to be very vulnerable to reversal of the capital inflows from which, of course, they benefited when US interest rates were at rock bottom levels. But as an empirical matter, these fears are hard to understand by many investors because there are a lot of countries that you have to follow. There is a lot of data that you have to accumulate, and there is the imminent US rate hike, which is perhaps the most predictable and predicted event in the economic history. Nobody, however, will be caught unawares if the Fed acts next week. As of course, many investors were in, let's say, February 1994 have made some records here. In June 2004, the only previous occasions remotely comparable to the current situation we are in right now. And even if in those cases, stock markets barely reached to the Fed tightening. While, of course, bond markets volatility proved short-lived. But what about currencies, ladies and gentlemen? We spoke in the beginning about the effect over the US dollar. So let's have a look about the dollar, which is, of course, almost universally expected to appreciate when US interest rates start rising, especially because the European Union and Japan will continue easing monetary conditions for many months, even probably years. We have yet to be informed about these conditions. Now, this fear of stronger dollar is the real reason for concern, bordering the panic in many emerging economies, and of course, obviously, in the International Monetary Fund. A significant strengthening in the dollar would indeed cause serious problems for emerging economies where businesses and governments have taken on larger dollar-denominated debt, and currency devaluation threatens to spin out of control. Fortunately, however, the market consensus concerning the dollar's inevitable rise as US rates increase is almost certainly wrong for three reasons. First, the divergence of monetary policy between the US and other major economies is already understood and accepted, which means the market has already priced into all of this. You saw how much the dollar appreciated over the 100 level of the Dixie. Extremely low levels of the euro versus the dollar. Of course, there are other fundamentals that play a huge role over there. With the Japanese yen as well, we saw levels of 124 very recently. The gold price dropped significantly for the past 1 year, about 50% from its major turn trend. As you understand, the prices of the precious metal were close to $2,000 an ounce. Right now, they're more close to $1,000 an ounce. So that's 50% from its historical peak. Moreover, monetary policy is not the only determinant for exchange rates. Trade deficit, however, and surpluses also matter, and as do stock market and property valuations. That, of course, cyclical outlook for corporate profits and positive or negative surpluses for economic growth and inflation are the outlooks and, of course, the measurements that the Federal Reserve is trying to implement to tailor a better economy and obviously eventually rise rates. Finally, the widely assumed correlation between monetary policy and currency volumes and their values, of course, does not stand up to empirical examination. In some cases, currencies move in the same direction as monetary policy. For example, when the yen dropped in response to the Bank of Japan's 2013 quantitative easing, but in other cases, the opposite happens as well. For example, when the euro and the pound both strengthened after their central banks began their quantitative easing programs, for the US, the evidence has been very, very mixed. Looking at the monetary tightening that began in the February 1994 and June 2004, the dollar strengthened substantially in both cases before the first rate hike, but then it weakened around 8%, as of course gouged by the Fed's dollar index, which is the Dixie, as we mentioned earlier. Over the next 2-3 years, the dollar index is expected to remain consistently below its level on the day of the first rate hike. For currency traders, therefore, the last 2 cycles of the federal tightening turned out to be classic examples of buy the rumor, sell the fact. It's a very well-known phrase among traders. Some of you might know it. Of course, past performance is no guarantee in 100% of future performance. And of course, 2 cases do not constitute a statistically significant example. Just because the dollar weakened twice during the last 2 periods of Fed funds rate tightening does not prove that the same thing will happen again. But it does mean that a rise in the dollar is not automatically inevitable if the Fed raises interest rates next week. The globally disputed effect, of course, of US monetary tightening, a rapidly rising dollar, capital outflows from emerging markets, financial distress of international dollar borrowers, of course, and chaotic currency devaluations in Asia and Latin America may loom less large in next year's economic outlook than in rear view glimpse of our precious 2015. Now, ladies and gentlemen, I will give you a very quick example, something that will also poke down to absolute details, as well as when we start speaking about our more appropriate trading strategies for the first quarter of 2016. I will give you an example of why most of the investors are still bullish on gold. First things first. Gold is hedged against inflation. Second, in both cases, next week, on an interest rate rise or unchanged policy, gold is more likely to appreciate than fall. Because we already mentioned, the market has priced in for the expectation of this rate hike. So no matter what happens, in the short term, we're expecting appreciation of the gold price, which is the brilliant gauge of the US economy and, of course, the global economy itself. That is why, for any currency traders, whether you're trading the Canadian dollar, the Australian dollar, the Japanese yen, the US dollar, whatever that you're trading, you have to see whether any kind of commodity has any connection with this currency, because there are widely known commodity currencies, the Canadian dollar, the Australian dollar, so on and so forth. But there are those which will be affected as well from commodity prices, not how to say instantaneously, but in the longer run they will be. Depending on whether the country is a large importer of any kind of commodities, like Japan, for example, is a large importer of crude oil. Anything else that is relevant to commodity prices is why we're looking at their levels prior to interest rate decision, because it will gauge the Federal Reserve's move. It is also something that investors are looking at. This is something that you should well know. Now, we're very, very quickly advancing in time. I will leave this chapter opened for next week, however, because Friday we will talk about investor sentiment. This is something that I want to separate the whole session for, because it's going to take us more than 45 to 60 minutes time, something that you need to know. And this is a mere trick to how to protect yourself from dangerous market environments. So we will leave on the market pricing, what is expected by the Federal Reserve next week, and we will talk about it on Wednesday, just 2 days before the decision itself, so we can reaffirm one more time everything we spoke about today and give you a better example, while everything we said sits in your head a little bit, so you can digest information that you just received, start looking at some economic data this week and next, because this Friday we have the retail sales, if I'm not mistaken, from US. I have to open the economic calendar. It might be something else, but if I'm not mistaken, it's retail sales. A huge gauge of financial stability. So that's all about today. Thank you very much for joining us. Whatever questions you have, you know how to find us. Just go to our website. Everything there is noticeable. You will directly get a pop-up from the support department. Just drop your question. If they're unable to answer to something more complex, I will take over from there, or some of my colleagues, whoever is available at this stage. Thank you, ladies and gentlemen, for being here today. Don't forget to join us. This month's webinars will give us what we need for the first quarter next year. See you next time. Bye-bye.